Think about the last few months. You probably made a $700 purchase you've already completely forgotten. But if you take that exact same one-time sum and put it somewhere else, it can become a $200,000 retirement portfolio. This chart tracks two different 30-year timelines. Both of them start at the exact same baseline, a single one-time investment of $700. Timeline A just lets that initial deposit sit and do its thing over 3 decades. Now let's look at Timeline B. We keep the same starting amount and the same 30-year win now, but we add one small variable, a daily contribution of exactly $1. That is $365 a year, less than what most spent on coffee. If we fast forward both timelines to the 30-year mark, the gap is massive. Timeline A ends up at a respectable $217,000, but Timeline B explodes to nearly $880,000. An extra $365 a year does not naturally add up to a $660,000 difference. To see how a single dollar a day creates that kind of distance, we have to look past the starting capital and look at the mathematical engine actually driving the growth. The gear turning this entire machine is the dividend. When you buy a share of a business, you own a real piece of it. If that company makes a profit, they can choose to take a slice of that cash and hand it straight back to the shareholders. That cash is the dividend. This visual shows exactly how we put that cash to work. Instead of spending a $4 dividend from a $100 share, you feed it directly back in. You use that $4 to automatically buy 0.04 new shares of the exact same company. Watch what happens in the following years. Because you now own 100.04 shares, next year's dividend pays out on a larger share count. That bigger payout buys even more shares, which increases the payout again in year 3 and year 4, all without adding a single penny of your own outside money. For the first few years, this process feels like an absolute crawl. The payouts only grow by a few cents. But as the share count gets steadily higher, the math takes over. Those pennies turn into dollars, and eventually the annual increases start out-earning your original investment. By reinvesting the dividends, you stop holding a static asset. You create an autonomous compounding engine that fuels itself. But this engine only runs if you feed it the right companies. Some stocks offer a massive dividend simply because their share price is crashing. That is a yield trap. To survive this portfolio screen, a stock must prove 3 things: a real yield backed by strong profits, a history of growing that dividend year after year, and a share price that is actually climbing. The baseline of this portfolio is an exchange-traded fund called SCHD. It acts as the anchor, giving you a foundation of 100 heavily vetted, dividend-paying companies that have decade-long track records of steady growth. Then we add individual operators. Take a look at these industrial warehouses in Southern California. This is the physical real estate behind a ticker called Rexford. Because there is virtually no empty land left near Los Angeles to build on, Rexford holds a near monopoly on warehouse space. That allows them to steadily raise rent on their 400 properties, funding a massive 5.10% yield. Next is Interparfums, and their business model is entirely different. They don't invent new fragrances. They license famous names like Coach and Jimmy Choo. By renting brands that are already global icons, they keep their overhead incredibly low. That efficiency translates to an aggressive dividend that grows roughly 19% every single year. This combine harvester represents the scale of our next asset, Farmer Mac. Someone has to finance the land and equipment for American farmers, and this government-chartered lender keeps cash flowing to rural operations. It offers a highly balanced combination of real income and a rapidly appreciating share price. The final spot goes to Nexstar Media Group. They are the largest owner of local TV stations in the country. Every election cycle, local broadcasting infrastructure absorbs massive influxes of political ad spending. That reliable cash machine fuels the fastest-growing dividend in the entire group. These aren't speculative bets. They are highly profitable, cash-flowing businesses. When you combine all 5, you get an optimized financial engine with an average starting yield of 3.69% and a payout that grows by over 17% annually. Let's bring this chart back and look at the first 10 years of our test. By year 10, Timeline A, the one with just the $700 start, is barely crawling. The balance is sitting at about $3,200, and it pays a negligible $169 for the entire year. This is the exact point where most investors quit because it feels like nothing is happening. But watch how Timeline B handles this vulnerable early phase. By adding just $1 a day, the balance at year 10 crosses $11,500. That extra daily mass forces the compounding snowball to grow faster, right when it needs it most. By year 20, that early momentum takes over the math entirely. Timeline B crosses $83,000 as the curve aggressively points upward, leaving Timeline A completely in the dust. When we hit the 30-year finale, the contrast is staggering. Timeline A finishes at an okay $217,000, but Timeline B goes nearly vertical, reaching $876,000 and generating over $10,000 a month in pure dividend income. Building real wealth rarely requires massive amounts of upfront capital. It requires building a high-quality compounding engine and then using a surprisingly small daily habit to push that engine past the breaking point of exponential growth.